And welcome to the workshop. This is election year investing. Are you prepared? I'm Paul Winkler, of course. A lot of people ask about the designations after my name. What is all of that stuff? That alphabet soup. Chartered financial consultant, chartered life underwriter. It's registered financial consultant, I'm forgetting what my own designations are. Life underwriter, training council fellow, chartered advisor for senior living, retirement income certified professional, wealth management certified professional. So these are all I'm very big on education. So all of the advisors that work for us around here, we all have multiple designations because I believe that we owe it to our clients to have a high level of knowledge about investing, about financial planning topics, everything from accumulating to distribution phase. So you look at the first designation, I think that was about a 3 or 4 year period of time it took to get that first designation. So I'm very big on lots of in-depth knowledge about investing. So I hope that comes through in today's workshop, that I know a few things about investing and financial planning. Now, one of the things we're going to talk about today is elections and markets. I want to tell you what we're going to talk about first. We're going to talk about the candidates. Trump versus Biden. We're going to talk about fear and anxiety, the things that people are feeling right now. Changing your lenses. We look at the world through lenses. We have people that we hang out with, family members, maybe our upbringing, and we have different ways of looking at the world. And I'm going to talk a little bit about that. I'm going to talk about, have we been here before? A lot of people saying we're going through something now, Paul, I've never been through, I've never seen in my lifetime. It's never been like this. We're going to talk a little bit about that. We're going to talk about how markets price elections. How do they change? How do the prices of stocks change inside of an election year? We'll talk a little bit about that. Socialism, worldview. Hey, realize we're not the only country in the world. There are other countries around. So we're going to talk a little bit about that, how other countries that are operated differently than us, how their stock markets have done over the years. Presidents and markets. So we're going to go back to the 1920s. We've had a lot of presidents over the years, and we've had different parties, Democrat, Republican. How have stock markets done under different presidents? Hey, there's data on this. Then we're going to talk about stock market predictions. And there are predictions about how the election is going to go based on how the stock market performs before the election. So we'll have a little fun with that and talk about that. And then talk a little bit about what really matters, what's really, really important as an investor, what you ought to be focusing on. And then other education outlets, that I think that you ought to embark upon and get involved in. And then what we did is we did some Q&A at the end as well regarding investing and financial planning and things going on right now. Now, this is our website. If you've never been there, paulwinkler.com. It's the most beautiful website on earth, as we like to say. Literally on the front page, you can actually schedule a call with us and set up a 15-minute phone call. Just talk to us. And, you're thinking about talking to you guys about what you do. You want to know more about what we do. You can do that right there, and you can schedule with all of the offices. I'll talk a little bit more about that as time goes on. And we can schedule virtual meetings. We're in that age now where people are not wanting to get out necessarily. And technology, good grief, we have clients all over the country. It's nice to be able to have the ability to have a virtual meeting online where you don't have to go anywhere. And of course, down at the bottom, it says that we're all either CFPs or CHFCs, Chartered Financial Consultants or Certified Financial Planners. These are two competing designations by different colleges, same level of education. So when you see one, they're both very, very similar to each other. But that's how you schedule calls, by clicking on that button right there. Now, let's get to the workshop. You have two different candidates, Biden, Trump, and they're very different approaches to how to run a country. One's going for re-election, one wants to be elected. And what I'm going to do is walk through some of the predictions that we're seeing out there. We're seeing predictions all over the place. Biden is going to have there's going to be a stock boom with the Biden election. Then there's somebody else saying he'd be a disaster for the stock market. And another one says that, he would recharge the stock market. No, he's going to be brutal for the market. No, Biden's going to be bullish for the market. And then Stu Varney saying, no, he's going to be terrible. It's the market. You better unload stocks if it looks like he's going to win. My favorite headline was this one: stocks to rise regardless of Trump or Biden win. And so we'll talk a little bit about that. Is that right? Which ones of these are actually more correct than the others? Now, one of the things I'm not going to talk about a whole lot is what if Trump wins, because he's a known quantity. We know what he's going to do. He's been in for 4 years. We know what his policies are. We know what he thinks about things. So I'm not going to spend a whole lot of time in regards to what happens if Trump wins. I'm going to spend more time on what if Biden wins, because that's where most of the predictions are coming from. What if Biden takes the election? What's going to happen? How's the market going to react? Now, in reality, that's why I'm doing this workshop, is because we fear the unknown. That's just how our brains work. Worry starts with a trigger. And, let's say if I'm worried about, my health, maybe I've got this, and maybe some kind of a pain in my side or something like that, and it starts me to worrying. Well, in this case, the pain in my side is the election. It's causing the worry that we're having as investors, because we don't know what's going to happen. It's the unknown. It's scary. And what we do is we get into this what if. Well, what if Biden becomes president? Well, what if he raises taxes? Well, what if he increases regulation? What if he, fill in the blank. Those are all the things that we worry about, right? And worry leads to anxiety. So we have this free-floating anxiety like, oh man, we are so good at worrying, and we just get so good at it that we don't even realize we're doing it. And we just have this free-floating anxiety. We can't figure out exactly what's going on, but we're just anxious. And when we're anxious all the time, we end up demoralized and exhausted. And it's because we're worried about the bad things that can happen. And what happens, we're tempted because we're so worried to take actions. And a lot of times they're really counterproductive actions, if you think about it. And, uncertainty is the worry fuel. It's the fuel that we're putting in our tank. And what happens is we tend to be very intolerant of uncertainty as humans. We tend to worry a lot, and we're intolerant of not knowing what's going to happen next. Now, there are two approaches to life, and I'm going to tell you, people fall in these two different groups, but most people do not fall in the first group. Most humans do not fall in this first group, where they have a tolerance for uncertainty. Let's say that I'm going to take a trip to Europe, and I do fall in this group. Well, the way I'm going to probably approach it is I'm going to buy a one-way ticket because I'm cool with uncertainty, right? And then what I'm going to do is I'm not going to pack any money. I'm not going to bring any money along with me because I kind of like the uncertainty, right? And I'm not going to have any plans. I don't know where I'm going, when I'm going to get there, when I'm coming back. I don't have a return date. And I may look at this trip and go, this is going to be great. This is going to be great fun. Now, for most of us, we're going to sit there and look at that and go, no way. That's not me. I'm not going to do that. On the other side, you might be intolerant of uncertainty. I can't stand not knowing what's going to happen. So I may be taking a trip to Europe, let's say, and I'm going to have a round trip. I know when I'm coming back, I'm going to have the cash. The cars are going to be all set. I know how I'm going to pay for stuff. I know where I'm staying. I've got an itinerary. I've got, if it rains, I know what I'm going to do if it rains, and I'm ready. I'm good. Let's go. Let's do it. I can do that because I know what's going to happen. Now, the question we got to ask ourselves is, what lens are we wearing when it comes to uncertainty? As humans, we look at life through a lens based on our background, based on our upbringing and the people that we hang out with. And we might have three different views. And quite often, the first view is what reigns. I don't know what's going to happen, and I'm scared about the negative stuff that can happen. So I have it in my brain, there's a negative outcome coming, man, and it's going to be really bad. It's going to be really scary. Now, I could, though, look at it and say, well, it could be neutral. It could be nothing good or bad necessarily happens with whatever the news is. But, most people don't think about this. You may have something uncertain happen to you, and it's really good. That usually doesn't come to our minds readily when it comes to uncertainty. Now, what we often fear is the worst case scenario. A new administration could come in, they could increase taxes, they could increase regulation, alter the Constitution, take away our rights, and they're going to crash the stock market, right? And it's easy to let our imaginations run away with these worst case outcomes. So we may say, well, oh my goodness, a new administration is going to increase the government, and that's going to lead to socialism. And then socialism, oh man, that always leads to communism. And it's really going to be bad, because if Biden wins, and people say he basically has said, I'm going to increase taxes. I'm going to increase regulation. He's pretty much has said it. He's not hiding it. That's what he wants to do. So what people do is they say, well, Biden win means the taxes will skyrocket because he said he's going to raise them. And businesses may fail. That's what our imaginations run to. That means businesses are going to fail. And we'll talk about that more in a little bit. And then companies are going to leave. They're going to leave America, leave the United States. They're going to head out and take off, and jobs are going to be lost. It's going to be terrible, and stocks are going to fall. And then what's going to happen is I'm going to lose everything, and I'm going to have to be living under a box, in a box under a bridge. That's going to be my new home. Because our minds, our imaginations race, don't they? And that's what we're worried about, is all of that stuff. And we don't think about it. Now, we don't sit there. If you said, oh, you think you're going to be living in a box under a bridge, you'd say, no, Paul, that's ridiculous. That's not what I'm thinking. But deep in our minds, a lot of times that is kind of what's going on backstage, as a psychologist would call it. It's subconscious. We don't even really rationally think about this kind of stuff, but that's where we are. Now, what I want to do is say, have we ever been here before? I mean, where we're concerned about the same things that people typically are concerned about right now. And what I'm hearing in the media and I'm hearing in various outlets, have we ever been here before? And I would submit, yeah, in a lot of ways we have. Let's go back to 1936. Alf Landon is running against Franklin Delano Roosevelt, and he is saying, Social Security is a bad deal, and we need to oppose this. And Republicans were opposed to Social Security at that point in time in 1935. So what happened is the concerns were that Social Security was going to be socialistic. We're transferring money from people that have money to people that aren't working anymore and retired. And now we're giving the government this right to tax employees, and they don't have that right to tax employees. It's unconstitutional is what they were saying, right? Does this sound kind of familiar, this type of talk? Probably does. Here's what Alf Landon had to say regarding Social Security and what its effect was going to be.
This is the largest tax bill in history. And to call it Social Security is a fraud on the working man.
So he wasn't necessarily in favor of it, and there were a lot of things they were putting out there saying, hey, they're going to take this money from you. Social Security at the time, you'll laugh at this because now it's a 6.2%, and your employer matches it at 6.2%. Well, back then it was 1%. And that's what they were coming in with, and they were scared about this. And they basically said, this is going to be really bad, and you know what? They're going to take money out of your paycheck, and you may not even get this money back. It could be gone forever. Say goodbye to this money, and there's no guarantee that they're going to give you your money back at any point in the future. Now, there was a Supreme Court decision that said, no, this is not unconstitutional. They can do this. And what happened is at that point in time, you had groups still railing against it. The National Association of Manufacturers and U.S. Chamber of Commerce railed against this bill. Ultra-conservatives were saying, no, this is going to be bad. And they've continued to say this is a bad thing ever since it's passed, according to one university. Now, there is nothing new about socialism fears. Roosevelt was criticized for his economic policies, that he was socialist, that he had communists in his cabinet and all of this. And Ludwig von Mises, you still have this school of thought in regards to very conservative economic thought processes that say that any move that we're doing in this way is kind of going back to Bismarck's Germany and socialistic and communistic thought processes and left-wing governments, and we're going to a paternalistic philosophy, and it's going to be a bad deal. My job is not to comment on the political stuff. I'm not here to talk about government politics. I think it's counterproductive for me to get into it. My job is to make you a more successful investor. So I'm not going to talk about the politics of any of this stuff. It's going to be about markets and investing, because that's what's important here, okay? Now, it's not that I don't have a political opinion at all, but I'm just not going there. Now, let's talk about from the time the Social Security Act was passed in 1935, 10 years hence, what happened in stock markets? Well, you notice something right here, that large U.S. stocks did pretty well. They almost doubled in value. $10,000 almost grew to about $20,000. Small companies, microcap, CRISP 910, those are microcap companies, very small US companies, more than quadrupled. If we look at large value companies, gee, almost 3 times growth, and the small value almost about a little bit over quadrupled as well. So you see a lot of areas of the US market that we have data on, pretty doggone good returns, even after the Social Security Act was passed. Now, so it didn't really negatively impact the market, you see. Now, if we look at this and say, well, when else does this kind of stuff happen in America? Well, Medicare. You think about Medicare, here's an insurance program where we're insuring a bunch of people over the age 65 who are the primary users of medical services. So we're talking about a huge amount of money that would go out taking care of the medical needs of elderly population. Now, the opposition was really strong to this. And this guy was, I guess he was giving a speech on TV because there's nobody in the audience. So I guess they just had the podium up there and he was speaking as if speaking to an audience, but it was on TV. But here's what this guy had to say about Medicare and its effect on the economy and why they were opposed to it.
Ladies and gentlemen, this King Anderson bill is a cruel hoax and a delusion. It wastefully covers millions who do not need it. It heartlessly ignores millions who do need coverage. It is not true insurance. It will create an enormous and unpredictable burden on every working taxpayer. It offers sharply limited benefits. It will undercut and destroy the wholesome growth of private, voluntary insurance and prepayment health programs for the aged, which offer flexible benefits in the full range of an individual's needs. It will lower the quality and availability of hospital services throughout our country. It will stand between the patient and his doctor. And it will serve as a forerunner of a different system of medicine for all Americans.
So does this sort of sound familiar to you? It was a great fear that they had in the 1960s. Now, if we look at from when Medicare was passed until approximately now, just recent history here, up through June of 2020, you see that large U.S. stocks, microcap stocks, which is the gray line, the black line, which is large value stocks, and the yellow line, which is small value, have done quite well, thank you. $1 invested in small value stocks worth over $1,000. Huge growth over that period in time. So it wasn't necessarily the big negative that people worried about by any stretch of the imagination. Now, if we look at socialist policies in general, let's just talk about that, how it affects the economy. Now, there are two different things. I want you to separate in your brain, separate the economy from the stock market. They're not necessarily as intertwined as you may think. The market understands that socialist policies might slow the growth of the economy and lower profits. That's not necessarily a debatable issue. It does happen. But what is really surprising to people is this. If you look at stocks and how they work, there was a study 1900 through 2002, and what they found is that in countries with growth rates, rapid growth rates, where the economy was growing well, they actually found that the market yields, the returns, were above average, or below the average, excuse me, of the other 16 countries. So in other words, high growth rate countries had lower returns in their stock markets. It is completely the opposite of what you would think. You would think it would be the other way around. High growth rates, great stock market. Not necessarily what you would think. Why? Well, markets reflect all known information. If you think about it, if I'm operating a company in a country where you're having some problems with government interference, there's more risk. As an investor in that company, I demand more return. So in essence, I demand more return when there's more risk, and there's more risk when there's lower growth rates, which just seems really counterintuitive, doesn't it? Now, this is a little shorter period study that was done that I pulled out, and it shows that in developed countries versus emerging market countries, it's a mixed bag. You know, sometimes the returns are a little bit higher in higher freedom countries, and sometimes they're lower. In developed countries, in the recent history, we have seen more economic freedom has turned into a little bit higher returns. And in emerging markets, it's the other way around. So it's a mixed bag. So you can't use this to predict the stock market either. I mean, you can't even use this. Is there more economic freedom? Okay, I'm going to go and put all my money in countries that have no economic freedom. That doesn't work either. So I just want to get that out of the way. Don't even try to game the system. You can't figure it out. Now, let's talk about political opinion polls and how they affect the stock market. Here was a study that I found in an academic journal that I thought was really well done, really interesting, and it answered a question that I have long talked about on the radio show. And what they said here was that in major political parties, when the government adopts systematically different policies, it does affect the stock market. In other words, the stock market doesn't operate in a vacuum. It is dependent upon the policies that the government actually puts in place. Now, research elsewhere has failed to they said has failed to find strong supportive evidence for this around election times. It was conjectured that stock market typically anticipates and so discounts, okay? So they're saying, well, you know, it's a mixed bag here. Again, I'm going to explain that in just a second, what that means. It said the outcome of general elections using available information from opinion surveys. In the event, a time series analysis did not reveal statistically significant general relationship between opinion poll movements and the stock market. However, if we have a close contest, it is significant. Now, what does all this gibberish mean? Let me break it down and explain what I just read, because it seems kind of confusing. If you have an election where there is a big difference between the two candidates, exceeding 10%, so the poll comes out and it looks like there's more than a 10% chance that this candidate is going to win versus this candidate. New polling data doesn't matter that much. In other words, there's such a big difference between the candidates that the likelihood of the one down here beating this one is minimal. But if you have two candidates that are close to each other, the polls do matter. So let's put it this way. If we look at this and we say, well, what does that mean? That means that the market is constantly digesting new information on who is ahead and who is behind, and how is that person going to affect the stock market. So I don't have to wait till November and to figure out who's going to win. And literally the stock market is adjusting in July based on who's likely to win in November. So that makes it futile for you to move your investment portfolio around based on, oh my goodness, I'm worried that this person's going to win. It makes it futile to take action. Taken overall, the results give qualified support to the view that the stock market prefers conservative administration. They're saying market prefers somebody that's conservative. And what happens is it responds positively to new information indicating an increase in the probability of that conservative person being elected or reelected. So in other words, don't try to use information on what you think is going to happen to the election to make investment decisions. Or put a different way, if you think candidate A is just awful, oh my goodness, they're terrible and they're going to be bad for the stock market. And let's assume that they are, for the sake of argument. They're a bad candidate. Let's say a poll comes out and says that it looks like candidate A is going to win. What will happen? The market will go down as soon as the poll is released. You don't even have to wait till November until the election happens. So by selling once you see the poll, you haven't protected yourself. You haven't done yourself any favors. So markets digest information. It's incredibly important to keep that in mind. Now, another thing that I want you to look at is this. We don't operate in a vacuum. America is just one country out of lots of countries. And the concern is, oh, we're becoming more socialistic, right? That's the concern that we have and what is being voiced out there. And more government interference is bad, right? Well, let's just take a look at that. If we look at Canada, France, Japan, UK, all of them are arguably more socialistic than the United States. They've got deeper social assistance plans, income tax credits, housing benefits, family benefits. Everything is greater in amount in those countries, in these socialistic programs, than the United States. So you would think that their stock markets would have way lower returns, right? Well, let's take a look at that. From 1970 through 1989, if you look at this chart right here, you see that the S&P 500, which is large US stocks right there, the return is actually less than a lot of other countries around the world, especially Japan in this particular instance. So we see that it wasn't necessarily bad to be in a more socialistic country, right? Now, I broke this up into two parts, 1970 through 1989, and then 1990 through now, for a very specific reason. And that is because in the 1980s, we're going through the Reagan Revolution, right? He was reducing taxes, reducing regulation, and it was free markets and, you know, capitalism and low government interference. That was the focus of the time, right? Now, from that point on, you actually had more government interference. And what I want you to notice is with more government interference, notice that the S&P 500 had a little bit of a better run. Now, the other areas of the market did pretty well as well, except for Japan, but Japan was having a huge problem with demographics, aging of their population, and lots of issues that I won't get into right here. But in essence, what we see was that it was pretty good all the way across the board, no matter what country we're talking about. And if we look at the whole period of time, it's pretty even Steven across the board right there. Didn't really matter where we were. Now let's take a look at returns based on who was in the presidency. And we're going to go back and we're starting all of our data in November of every year. November 1928, well, because that's when the election occurred, right? So we're going to start the data at November because then we know who the president's going to be, and then the market responds based on who the president's going to be, and then we're going to go forward 4 years for each term. First president up is Herbert Hoover. Republican, got a bad rap, got a lot of bad stuff that was thrown his way. The Federal Reserve made all kinds of mistakes. You know, there are all kinds of tariffs. He made some mistakes, adding tariffs at a really bad time. And then Federal Reserve missteps caused the economy just to tank during the Depression. And we see that it doesn't matter where you were. Large US stocks, small, micro cap, large value, small value. It was bad across the board. Notice, however, that if you were in treasuries and T-bills, government bonds, you did okay. And if you were retired during the Depression, you wanted to have those bonds to draw income off of to buy you time for when stock markets recovered. Because actually, when Roosevelt came in, they did recover, as you can see right here. So we had a significant recovery in large US stocks, small and micro cap, and this is in the midst of the Depression. And this is how big the stock market returns were during this period of time. You see about an 8-fold increase in value in microcap stocks, you see, so it was huge. Then Roosevelt gets another term. Market goes down. Why? Well, because we were around the world, World War II is starting to brew, and that was a negative, and people were scared about that. So markets went back down. Again, treasuries to the rescue during that period of time. Then he gets a third term. And we're in the midst of the war. You think, oh my goodness, we're in the midst of a war. It ought to be really bad on the economy, right? No, not exactly. The economy was really good because we were producing all kinds of things. And economically, it was good for our corporations that we owned around the United States, large, small, and value and growth alike. Now, if we look at this period of time right now, we look at this, we'll say, wait a minute, that was a third term. Yeah, well, it used to be that we didn't have 2-term limits for presidents. So he went for a third term, and then, you know, another one right here. And again, market's up. And even going into the end of the war, and then going a couple of years afterward, we had some significantly positive markets. Then Truman comes in, And Truman continues on, economy's doing well, and we get into the early 1950s, stock market still pretty significant growth. $100,000 grew to about $200,000 in large US stocks and so on and so forth, all the different asset categories along the way, small value, about the same return. Then Eisenhower gets in, and again, we have some really good returns with Eisenhower. You can see that. Republican comes in office, and we're talking about the late 50s here, mid to late 50s here. And then Eisenhower gets another election, and then we have great growth rates at that point in time. And then we switch over to John Kennedy. John F. Kennedy comes in, and again, good markets, even though we're going through the Cuban Missile Crisis and all kinds of the fear that was going on in the early 60s, the worry that we had about all of a sudden the Russians putting missiles in Cuba, so that was a big concern, but that didn't stop markets from climbing, even though we had all of that bad stuff going on. And of course we have, Vietnam War, and that was a very unpopular war. We talk about unrest and people out there rioting and picketing and all of the stuff that was going on in college campuses around America. There was a lot of unrest during that period of time, political and civil unrest. And yet stock markets just trucked along. Large US stocks, okay returns, but small companies, really good returns. Microcap, great returns, and small value, large value. Then Nixon comes in, and of course that was a difficult period of time because we have, all the issues during the Nixon presidency and price fixing coming off the gold standard and the worries there. And then during his second term, it had all the issues with the oil crisis starting to kick in and the embargoes and all of the scandals with, of course, impeachment and all of that. So, but, that didn't mean all areas of the market did poorly. Large value stocks did well. Small value stocks did well during that period in time. And the black line, of course, is, if you haven't figured it out, is $100,000. That's my starting investment amount and what it grew to. If the bar is above the black line, you see growth. Then Jimmy Carter comes in, and you think, oh my goodness, what a mess that was. We had stagflation, stagnant economy with inflation. That never happens. Economists had to come up with a new term to explain what was going on. Normally, you only have inflation if the economy's rip-roaring. In this case, we had a stagnant economy in inflation, unheard of. And yet the stock market did really well. Even the economy was stinking up the joint. So he didn't get a second term. The economy was so bad, right? Reagan came in, and Reagan almost didn't get a second term. I mean, good grief. It took a while for the economy to start to recover in like mid 1982, 1983, I think it was, before the economy started to come back. But the whole time the stock market did fairly well. And international markets too, decent returns in the international market. Now we have data on international, as you noticed in the past couple of slides, because really good data on international markets starts in 1970. And then we see the late part of Reagan, the second part of his second term, we see international markets just knocked it out of the park. And we think, wow, US was doing really well during his second term. People forget that it also helped international markets pretty significantly. Then George Bush comes in, and across the board, we see decent results. Across the board, except for international wasn't quite as good during that period in time. And then in the 90s, we have Bill Clinton comes in, and he benefits significantly from the productivity increases that we had, because computer technology is really starting to rip roar. And, I got my first laptop computer in 1989. I was writing life insurance applications on a computer and sending them over the internet, believe it or not, in 1989. So in essence, we have really good markets because of productivity increases. In the late 90s, again, looking really, really good. And then Bush comes in, and we have really good. The international was small companies, small value, which is not on here. International did really, really well, and large international value did really well. That's not on here as well. But U.S. markets were hit and miss. Large U.S. stocks, we literally had a dead decade, an entire 10-year period with no return whatsoever. Really, really bad. And we see the drop right here in large US stocks because the tech bubble burst. And then during the second half, you literally had kind of flat markets, mainly because of 2008. So this data includes late 2007 and 2008, and up until late 2007, 2008, things were great, things were fine. But because this includes that '08 number, it's basically flat. But again, we have treasury bills. That's what helped. If you were taking an income during this period of time, you could take income from there. Then Obama comes in and the markets recover, phenomenal returns, almost doubling in many areas during his first term, $100,000. And again, the same thing during his second term, tremendous results across the board. Then you have Trump. Now, Trump has been interesting. Trump came in and he said, I want to weaken the US dollar in order to help our companies that do exporting, and that didn't work out so well for him. And we didn't necessarily have a weakening of the dollar because a lot of his policies actually strengthened the dollar. And what has happened, which is really, really interesting, notice the S&P 500 versus every other area of the market, how skewed this one chart is right here versus everything else we've seen so far throughout all of history. What's going on here? What's going on is we basically have been going through protectionism, raising tariffs on other countries. It's affected not only US companies, but international companies. But also we had this thing called COVID. We have this virus that has actually benefited who? Really big US companies. And specifically, about 6 companies make up about 25% of the S&P 500 right now as I speak. It's unheard of. And those 6 companies are all companies that have benefited from the revolution to doing stuff online like what we're doing right here. You know, so you have them, they're called the FanMag companies. Facebook, Apple, Netflix, Microsoft is the M, and then we've got Amazon, and you got Google, and these are all, people are shopping at home. People are getting on their computers. They're doing a lot of internet work. So these companies, so do I think that these trees are going to continue to grow to heaven? No way. So this is where I see investors right now, people that are worried about the market right now. I think if an investor is really concentrated in this one area of the market, I kind of would be nervous. I don't make predictions about market direction, but I'd be nervous simply because this is such a skewed market right now. And I'm going to talk a little about what you can do in a second and to protect yourself from this kind of thing. Now, in general, Democrat versus Republican returns, going back to 1928, we see that it's skewed in favor actually of Democrats historically. Now, we've had positive returns with both parties. But if we looked at why is it skewed, well, a lot of the really big recoveries have occurred when Democrats happen to be in office. I mean, the Depression was a huge one. That's a big skewer. And then 2009, again, another big skewing right there. Now, if we look at 63 to 2020, we see, again, Democrats in all areas of the market. And if we see from 1988 till now, we see a skewing, a little bit of a skewing in most markets of Democrats versus Republicans as well. And it's very different than what most people expect when they look at the data. Now, one of the things people say, well, who's going to win this election, Paul? How do you know who's going to win the election? I don't have a clue. But, there is a really interesting thing out there that I saw in Advisor News. And what they were looking at is how the S&P 500, large US stocks, how they have been a good predictor of the election before it happened. In 20 out of 23 elections, if the S&P 500 was up in the 3 months prior to the election, the incumbent party tended to stay in the White House. So if the market was down, they tended, not always, but they tended to lose the White House. So it's just interesting that you can look at something like this and say what might happen in the election. The market has actually shown us a little bit of that. But what do I want to take from this data right here? There is actually an interesting takeaway, and it's this. Presidents don't make markets. Markets make presidents. Think about this. What do you always hear when it comes to elections? It's the economy, stupid. You know, it's economics. It's how are people doing on Main Street? If the leadership causes economic damage, whether it be the Senate, whether it be the House, whether it be the president, it will not be long before the leadership changes again. Because we'll have another election in 2 years. Now, it may not be the president, but it could change what is going on in Congress significantly. And realize that another person or another group coming in, what do they tend to do? A lot of times they'll overturn what the previous group did. And it doesn't take them long to do it. If it's been damaging, they'll do it because they want to fix things, because if they fix things and the economy gets better, their chances of getting reelected are significantly improved. So what should you be doing as an investor? Well, number one, focus on academics. My goodness, there is research out there that goes back 60, 70 years that gets ignored routinely by Wall Street because they don't make money on it. You know, it's not a big money maker, so, you know, it doesn't drive the bottom line of the big investment firms. And that's why we are so focused on, we don't represent investment firms. We don't represent mutual fund companies. We don't represent insurance companies. When we give advice, we represent you, the client. And that's why, because I don't want to have a dog in that fight. I think it creates a conflict of interest. In the academic world, there is this idea of efficient frontier, and this is the idea that we can maximize expected return for given levels of risk. So let's say that I've got all my money in the S&P 500. Historically, you see the return is, trace it back to the left, somewhere between 9 and 10% per year return in the S&P 500. The risk is between 18 and 19. That's the bottom scale. So that's a significant amount of risk. If I'm young, I can take that kind of risk. Not a big deal. I have lots of time. But if I'm older, I may not want to take that risk, and I might want to do something a little different. But let's say I'm young. If I put all my money in the S&P 500, I have a lower expected return than if I diversify between large and small, growth, value, international, US. Why? Because as you noticed, they move in dissimilar fashion. You'll have one period of time where one's doing really well and the other one's kind of stinking up the place. And then you'll have another period of time where the thing that was doing well, like large US stocks, maybe was doing well, and then that's stinking up the place, and international companies are doing really, really well. And when you put them together, what happens is we tend to have this reduction in overall risk of the portfolio, and that is really beneficial to the investor. So we can pick up additional expected return with the same amount of risk. Now, if I'm older and I say, I can't take that kind of risk, I need to shift back to the left, what I can do is I can essentially pick up the same expected return with a fraction of the risk by adding fixed income and bonds. Because what did you notice about bonds? When the stock market went down, the bonds typically tended to go up to offset some of that and it allows me to take income from there when I'm pulling income in retirement. So when you're properly diversified, there's always something in your portfolio doing okay. And that's why we diversify the way we do. So number one, that's the way we do. Now, how do we determine this investment mix? Well, it's based on time horizons. Now, if I've got a long period of time, I can go more stocks. If I got a lesser period of time, and I'm going to be holding more of those bonds. Now, how much in bonds, how much in stocks, that's more of a financial planning conversation, because it can get really complicated and get how long before I'm going to take income, how much income am I going to take, what type of return is necessary, don't take risk that I don't need to take. There are a lot of things that go into that. And that's a conversation when we get into financial planning that we actually get really in detail, really detailed on. Now, another piece of academic research won the Nobel Prize in 2013. And one of the guys that came up with this research, I spent a lot of time studying under him and working, going to classes that he taught and in seminars all around the country. And one of the things that he taught about was where returns come from. How do I figure out the expected return of a portfolio? And it really gets down to what areas of the market I'm exposed to and how I'm exposed to them. What he found was that small companies had a higher expected return than large companies. And there was a really good reason for it. He found that value companies had a higher expected return than growth companies. So in essence, he said, oh, gee, if all I want is maximum return, put it all in small value. That's where my maximum expected return will come from. Now, if I didn't feel worthy of great returns, I should just put all my money in large growth companies down in the lower right-hand or left-hand quadrant, down there where that blue arrow is. Now, if we look at what fund companies do, it's pretty interesting. If you look at this right here, this is a grouping. I did an averaging of all mutual funds that invest money for a retirement date of 2040. And what I want you to notice is this. There's this thing called a style box right there. And that tells us where the money is invested. And what you notice is the big numbers are all in the top. In other words, they're concentrating most of the money down where? In this lower left-hand quadrant. Why? Well, it's because what Americans are familiar with. People tend to be comfortable with big US companies. And the interesting thing right now is I did a workshop called The Perfect Storm not that long ago, talking about how this is kind of dangerous. We got a lot of people that are really excited about big companies that they recognize whose price is really high and they just had a big run up. That could be really, really dangerous for investors. So what we want to do is we want to be more compartmentalized in all of these areas because that helps reduce the risk of the investment portfolio when we do that. Now, we don't want to just do that in the United States. We want to do it in the US and around the world. Now, the other thing is this. Brinson, Hood, and Biebauer, academics did studies on pension plans. And they said, well, why did these pensions have different returns over the same period of time? What drives returns of an investment portfolio? If we can know that, we can know what we should be focusing on. And what they found was that what a lot of people focus on, which is, hey, what's this president going to do? What's this Congress going to do? Should I get in the market right now? What are these companies going to do? What is this area of the market going to do? What's China going to do next? Market timing is what we call that. By changing, when we change a portfolio based on what we think is going to happen in the future, that is by definition market timing. And when pensions engaged in it, it hardly had any impact on the return. And in a second, I'll tell you what impact it did have. Other factors, no impact. Stock selection, which stocks they held. You'd think that'd be hugely important. Which stocks they held versus other pensions. Not important. And in fact, when this is what they focused on, it had a negative impact on performance. The positive, the thing that we focus on and what we should focus our time on is this. What asset mix do we have? How much in large companies? How much should we have in value companies? International, US, small, large, bonds, what types of bonds? That's what matters. So the academic research is clear. Make sure you're putting together a portfolio to maximize expected return based on time horizons, based on how things move with and against each other. It's called correlations. What we call that, putting a portfolio together based on correlation coefficients to be exact. Then we want to make sure that we are looking at the different factors, as we call them, to make sure that we have the large and the small and the value and the growth in all areas of the market, emerging markets as well. And then asset allocation is what we focus on. We got to get out of this cycle. I'm telling you, this is the biggest reason investors fail, bar none. We have a fear of the future. I'm nervous. What's going to happen? What's the election going to do? What's happening politically? What's happening in our country? What's happening economically and socially? And because of that, we want to forecast or predict the future. I want to figure out what's going to happen. I protect myself against what's going to happen. Well, I can't do it. Who can? So I look at the track record of people that did it in the past. And then everybody tells me that they're the best. I get overloaded with information. That's the next step in the cycle. And then I finally just go, I don't know who to trust. And then greed takes over, fear takes over, trust, loyalty, all of the emotions that I have just drive the bus. And then I make bad mistakes and I end up breaking rules of investing. I lose money and I end up back in the cycle all over again. There's only one way to get out of this. I'm telling you, the only way that I've ever been able to get people out of this cycle is through education. The more you know, the more, yeah, you don't have to understand everything. You don't have to know everything I know. But the reality of it is, if you understand how markets work, where returns come from, just the basic things, your level of peace of mind goes way up, and then you don't tend to make these big mistakes. Where we get education counts. One of the places I always direct people to is my website, because we got a lot of stuff on the website that you can go and just build up your brain. You can go to the podcast. We got a lot of subscribers to our podcast every week. The radio shows from 3 to 6 on Saturdays here in Nashville, but no matter where you are in the world, you download the podcast and you can get it. You can be driving around in your car and have it on your phone at any point in time. We have videos that we do on educational topics. There's a whole video library in there. And the other thing is the blog, the written blog. What I'm doing is I'm writing a book on financial planning. And each chapter that I write, we are putting that in the blog, and you can go there and read that. But what's going to happen is when I get finished with the book, we're going to pull all those chapters and put it into book form. For right now, it's there for free. Go check it out. Feel free. And that'll give you a big leg up on things you ought to be thinking about from a financial planning perspective. And again, schedule a call. You can come in, talk to us. Some people feel better with a virtual meeting, so you can do that. But you can schedule a call at any of our offices. The way that works is if you click on that button, schedule a call, you'll see a list of all our different offices. And if you've never talked to us, you want to know more about what we do, this is the way to do it. You can schedule a free 15-minute phone call. You find whichever office you're closest to. Let's say the Goodlettsville office, you go and click on the Goodlettsville office. And then you'll get a calendar. And you can literally, this is how easy it is. You can literally go down there in the calendar and put yourself on our schedule for a 15-minute phone call. So I urge you to do that. If you've never talked to any of us before and you want to see if I'm in the right spot, do I have any problems, do I have anything to worry about, we'll let you know right away. And let you know if there are any issues, and give you an idea of how to go forward, what we do and how it works. So take us up on that. It's a great way to kind of kick the tires and see what it is that we do around here. The other thing you can do is this. If you want to know, hey, how much do I know already about investing? You can do this quiz. It says test your knowledge. You can go and take our investor quiz, go in there and see how you do on that. And if for no other reason, you'll find out what you need to know more about. Then also, we have the playbook, and it just talks about my background, my history, my philosophy, why I started the company, why we do what we do. It's a great read to just kind of get a good familiarity and get a real comfort level with what we do and why we do it. And then, of course, there's my book, Confident Investing. That's my second book that I've written. And it's on investing. It's all academics. And it's, a lot of the books out there, it's written by, you got companies and mutual fund companies write these books, and it's just big sales brochure for their investing philosophy. This is just all academic in nature. So, and not like academics, it's just because there's not a dog in the fight from an investing sales standpoint. So it's always a great read. That's one of the things that we have people do is go through that as well as part of the education process. You can get a leg up on that. Now, questions that we have. We have a couple questions that I'm going to hit really quickly here. So one of the questions that we had was, so I'm about 10 years from retirement. I don't have to worry about the election, Paul, and I'm just paraphrasing the question. In essence, if you have about 10 years, there is a workshop I'm going to direct you to that I think is a really good thing to check out. We had like, good grief, 50, 60,000 downloads of this workshop, or views of it. But it was Too Old for This, I think was the name of the workshop on the website. Am I too old for this? It's something like that. You'll be able to find it on paulwinkler.com. But it talks about market downturns and the amount of time it took for recoveries to occur. Because a lot of people were asking themselves, am I too old for a market downturn? So I'm going to talk about that. You can go and talk about that there. But let me talk about what you do. If you got 10 years to retirement, even in retirement, you want to have exposure to stocks in most cases because of inflation. Inflation is prices going up. what is inflation? Is prices going up? Who's raising prices? Companies. What do I own when I own stocks? Companies. If you have all your money in fixed income investments, you could be at huge risk, because back in the 1930s, you could buy a house for about $30,000. Now it's $300,000. I was talking to somebody today and they said, oh my goodness, Paul, we bought our first car and we had to make payments on it. And I said, how much was it? $3,000. And I said, yeah, you think about it, that was a lot of money back in the 1970s. Now it's $30,000, $40,000, right? So the dollar keeps going down in value. And right now, fixed income investments, the rate of return is negative. It's a guaranteed loss right now that you're dealing with fixed income investments. So we want to hold equities. Let's say you're 10 years out, like this person's question is. You know, you could have a situation where you might have, let's say, 75% stocks. I'll just use that as an example. And what you want to do is little by little move back to where you might have maybe 50, 60% stocks in a portfolio. So let's just use 60. So I'm at 75. I need to get down to 60. That's a 15% move, and I've got 10 years to do it. So what would I do? I might change the portfolio mix by 1.5% per year. So I'm at 75. I'll be at 73.5. Then I'll drop to 72%. And then the next year I'll be at 70.5. And little by little, what I do is I drop down that way. So do you do nothing in the management? No, there are things going on in the portfolio all the time, but that's how you would gear toward getting to your retirement date. Now that'll vary based on how long and how much income you're going to take, but yeah, good question. Other questions? We had Michael. Social Security. Oh yeah, thank you. Social Security, what about that? What risk do we have with Social Security? A lot of people are worried about it. Social Security is money coming out of people's paychecks and going to people that are in retirement. It has always been there. Remember earlier in the workshop, I talked about that how it was a 1% tax in the beginning. Now it's 6.2%. There are fewer people working for every person in retirement, so the taxes are higher right now. The concern is this: the trust fund's going to go away. If the trust fund goes totally bankrupt, goes away, there'll still be enough money to pay 80% of benefits approximately. So it's not going away, A. Number two, the other thing is that there are things that can be done to shore up the system. They could increase it. Instead of 6.2%, they could increase it above that. They could push up younger people's retirement age. Instead of 67, they could push that up to 70. They could increase the tax on it. They could decrease the COLA on it. There are a lot of moving parts to Social Security that could actually help shore up the system. So Social Security, it's a political football. A lot of people use it to scare people right now, but there's a lot more to the story. Any other questions?
The final one asking about suspending RMDs this year.
Good question. Okay, so suspending required minimum distributions. Yes, there was a law change requiring, and people are actually, if you, let's say, turn 70.5 last year, 2019, you still have to take what's called a required minimum distribution on your retirement accounts, unless we're talking about a 401k and you're still working there. So there are rules that you got to understand. But this is just, let's say you have an IRA. You have to take a required minimum distribution by April 1st of the year following the year you turn 70.5. If that's all confusing, just call us, let us know, and we'll walk you through it. But if you turn 70.5 after 2019, you can wait until age 72 now. That's a law change. You can push it off. Now, there are all kinds of really interesting planning implications that have come about since that has changed. And basically what happens is your distribution amount, it's kind of weird. What they do is they take your distribution amount and it's based on you being married to somebody 10 years younger than you. So let's say if you're 72, the government imagines that you're married to somebody age 62. And that's the beauty of it. You're always taking a percentage of whatever's in your investment account. So you can't run the portfolio dry. So it might be just shy of 4% of your investment account. So if you have $100,000, your required distribution is going to be about $4,000. Well, I can't run the portfolio down if it's always a percentage of whatever's there, if that makes any sense. So I think that's it. We covered all the questions, and I want to thank everybody for tuning in. Hope you enjoyed this. Share this. share this with friends, because a lot of people are really, really concerned about this. And I think you'd give them just great peace of mind just sharing this workshop and say, hey, you're worried about the election, worried about what's going on. And again, I came at this from a standpoint of what if Biden wins? This is apolitical. I just want you to get that that's what people are concerned about, the unknown. And I hope this has been helpful. Have a great one, guys.